Accrued revenue is uncollected revenue, that is, revenue earned but not yet received. To put it another way, receipt of cash takes place after the revenue is earned and recorded on the books. Every adjusting entry for accrued revenue debits a receivable account, increasing assets on the balance sheet, and credits a revenue account, increasing revenue and net income on that period's income statement. Examples of accrued revenue include commissions and royalties earned but not yet received, interest earned on customers' notes and company investments in long-term bonds and short-term notes but not yet received, space leased to a tenant for a period for which rent has not yet been received. Failure to record accrued revenue will have the following impacts on the financial statements. Assets will be understated on the balance sheet because the omitted entry increases a receivable account. Revenues will be understated on the income statement because the omitted entry increases a revenue account, and as a result, net income will be understated on the income statement. Example 1. A company with the year end of December 31st rents space to a tenant for $1,000 per month. The December rent has not been received as of December 31st. What is the adjusting journal entry on December 31st? Because 1 month's rent revenue of $1,000 has accrued, the adjusting journal entry on December 31st is debit rent receivable of $1,000, credit rent revenue for $1,000 to accrue 1 month's rent revenue. Even though December's rent of $1,000 has not been received, the company has still earned it because the tenant used the space during December. Example 2. Geico contracts to sell widgets for a customer in return for a 10% commission on sales. As of Geico's year end, the project has produced $140,000 in sales, but Geico has received only $5,000 in commissions. What adjusting journal entry does Geico record at year end? First, compute commissions due on the $140,000 in sales. $140,000 times 10% equals $14,000 commissions. Then compute commissions accrued, earned but not received, by deducting the payment received from the total earned. $14,000 commissions earned minus $5,000 received equals $9,000 commissions accrued. To record the adjusting journal entry at year end, debit commission receivable $9,000, credit commission revenue for $9,000 to accrue commission earned. Accruing interest receivable. On a short-term note, interest accrues or builds up and is usually received with payment of principal or face amount of the note on the due date. On a long-term note, interest is received periodically rather than when the note is due. If the accounting period ends before the interest is received in cash, interest is accrued to the last day of that period. The formula to compute the interest for a period is principal or face amount times annual interest rate times fraction of year equals accrued interest. If your company converts a customer's overdue accounts receivable to a note, the customer will not pay either interest or principal until the note is due. When the accounts receivable is converted to a note, 2 entries are required. The first entry is to record the new note, debit note receivable, credit accounts receivable to record conversion of accounts receivable to note. The second entry is to accrue the first year's interest, debit interest receivable, credit interest revenue to accrue monthly interest revenue. Hilltop Company holds a customer's $1,000 90-day note which is dated November 1st and bears interest of 12%. The company's year-end is December 31st. How much interest revenue is accrued as of December 31st? Interest is stated on an annual basis unless otherwise specified on the loan document. As of December 31st, interest has accrued for 2 months, November and December. Applying the formula to compute interest, $1,000 principal or face amount times 12% equals $120 for the year, divided by 12 months equals $10 per month interest, times 2 months, November and December, equals $20 accrued interest as of December 31st. To record the accrued interest, the following adjusting entry is made in the General Journal. Debit interest receivable, $20. Credit interest revenue, $20, to accrue 2 months interest on $1,000 12% note. Huntington Company, which has a year-end of December 31st, holds a customer's $2,000 10% interest per year, 1-year note due April 1st, 2020. The customer will repay the principal and all interest on the note's maturity date or due date. How much interest accrues as of December 31st, 2019, and what is the entry to record it? To compute interest accrued on December 31st, 2019, $2,000 principal times 10% interest equals $200 annual interest times 9/12 months for the 9 months April through December equals $150 interest accrued as of December 31st. Huntington records the following entry. Debit interest receivable, $150. Credit interest revenue, $150, to accrue 9 months interest earned on $2,000 10% note. Cara Company holds a $50,000 8% note receivable, interest payable annually on each June 30th. When Cara Company's fiscal year ends on August 31st, 2019, you have received no interest payment since June 30th, 2019. What adjusting journal entry do you make? You debit interest receivable, $667. You credit interest revenue, $667, to accrue 2 months interest on note, $50,000 times 8% times 2/12. If Cara Company's fiscal year ended on December 31st, 2019, and you had not received the interest payment since June 30th, 2019, what entry would you make? Debit interest receivable, $2,000. Credit interest revenue, $2,000, to accrue 6 months interest on note, $50,000 times 8% times 6/12. Cara Company rents a machine to another company at an annual rental of $15,000. At year end, you have received $13,500 in rent. Record the adjusting journal entry. Debit rent receivable, $1,500. Credit rent revenue, $1,500, to accrue rental revenue. You have collected $13,500 of the $15,000 earned. Thus, the amount to accrue is $1,500. $15,000 minus $13,500. Alpha Company holds Beta Company's $60,000 12% mortgage on which it has collected $7,000 in interest for the year. What adjusting entry do you record at year end? Debit interest receivable, $200. Credit interest revenue, $200 to accrue interest revenue. Alpha Company is entitled to $7,200 in interest for the year. To compute, $60,000 principal or face amount times 12% equals $7,200 interest for the year minus $7,000 received equals $200 accrued interest. That is, interest that Alpha Company will receive. Alpha Company has a 60-day, $3,000 12% note receivable dated December 1st. What adjusting journal entry do you record on December 31st if you have received no interest payments? Debit interest receivable, $30. Credit interest revenue, $30 to accrue 1 month's interest earned on note. $3,000 times 12% times 1/12. The adjusting entry accrues 1 month's interest. Although the note is for 60 days, the interest rate is stated as an annual rate and therefore must be divided by 12 to find the interest that has accrued for 1 month.